Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
Hello, I'm Piers Butler in London, and welcome to the Macro Brief from HSBC Global Investment Research, where we look at the issues driving financial markets across the globe. And it's the last episode of 2025. On the podcast this year, we've covered everything from trade and tariffs to artificial intelligence, currencies, and the gold price rally. And today, we're going to be talking about a topic that you're likely to be hearing a lot more about in 2026, digital assets. Think cryptocurrencies, Bitcoin and blockchain. So here to tell us what we should be looking out for is Daragh Maher, Head of Digital Assets Research. Daragh, welcome back to the podcast.
Thank you. And just hearing that, you saved the best to last. Is that the line we're going to
Exactly.
use? Good man.
Exactly.
Good man.
So I'm actually going to sort of look back
Okay.
to start our conversation. 30 years ago, an author called Nicholas Negroponte published his seminal book, Being Digital. I read it about 20 years ago, and the overall premise for me was that everything that could be digitized would be digitized. And every year since then, more has been. So my first question is, looking back at 2025, can we say that it was the year that digital money in its various forms moved from the edge to the center of the debate? Is money going digital?
Good question. I like the throwback 30 years. Look, I think this is definitely where the year in which we will say tokenized money, digital money went mainstream, right? We moved from it very much being a niche part of the conversation into the center ground. I saw one statistic, and we used it in a report recently, that mentions of the word stablecoin in corporate earnings announcements rose 8,000% year on year.
8,000%?
8,000. That's a good number,
That's
right?
That is.
My father was a journalist. He always said you should make it would be more compelling if it was 8,011, but the actual number was 8,000. But I think that shows how much has moved into the conversation, and how much more we've all been forced to learn about it in a way, because it is not this niche thing. I mean, I think there is a sense that money has been digital for a while, right? I mean, I think you don't carry around too much cash in your pocket. I don't think many people do. But this was a year where it became, if you like, a tokenized version. So it moved from being digital to being potentially on the blockchain, and that carries a lot of additional benefits, additional complications, but I think that's why it's been interesting this time around.
So we're going to drill into that. In your work this year, you've covered cryptocurrencies, stablecoins, and tokenized deposits, all forms of digital money, as you have explained in the previous podcast, and I would encourage our listeners to listen to that. But who is winning the battle for supremacy? You have referred to tokenized deposits as a sleeping giant. So is the giant waking up?
I think the tokenized deposit giant's kind of rolled over in its sleep and grunted a bit, right? I think that's as much as we could really say.
That's quite an imagery.
Yeah, there
Hope it
you
doesn't
go.
crush anybody in the process.
It's exactly that. It's still got all that capability, right? It's got scale, as you say. It's a giant. So if we look at deposits in the banking system, they are just enormous, right? And if banks choose to tokenize them at scale, you've then got this enormous payment vehicle operating on blockchain rails, right? So that the significance is still there. Banks have definitely been trying it out. HSBC has been doing it quite successfully. It still feels that they're kind of pilot, although they're for real value, these transactions. It's not just let's pretend we're moving money. There is real money being moved and deployed. They are still kind of proof of concept and pilot schemes. Whereas still at this point, stablecoins, there is a lot of money moving through stablecoin channels. Now, a lot of it is bots and not necessarily with human intervention, but the figures are big, right? And I think tokenized deposits, therefore, are still the sleeping giant, but I think they're the ones rumbling along in the background and will be a bigger thing, I think, in 2026.
Is it fair to say, when you talk about stablecoins, one of the sort of measures of the scale is the sort of treasury deposits that they hold as security? It's quite a significant number, isn't it?
Yeah, so, I mean, I guess the way we could look at how big are stablecoins? Because literally there is only a stablecoin because somebody's handed over $1 to get one, right?
Yeah.
So the market cap of stablecoins is literally the level of demand, right? And we're operating just shy of $300 billion, right? So, and a big portion of that is parked in US Treasuries and predominantly in US T-bills, which of course is why America loves it, right? Or at least the US Treasury loves it because it's another form of demand for T-bills. But that's still relatively small, and that's, and I say that in the context, let's say, of a treasury market that's 27, 28 trillion, and I've just mentioned 0.3.
Yeah.
Of course, where it gets interesting is if you start saying, well, hold on, that 0.3 could become 2 trillion or 3, and frankly, you can make up any number you want, and no one can dispute it. But then to come back to the earlier question, yeah, but what are deposits? Deposits are like 50, 70, 100 trillion, depending on how many economies you include.
Yeah.
And they're already within AML, anti-money laundering, know your client, all those kind of areas that we're worried about. But stablecoins, yeah, they are significant and they're liked in America because of what they bring to that T-bill demand.
So sticking with America, there was a lot of excitement earlier in the year when President Trump declared that he wanted to make the US the crypto capital of the world. And to reinforce that, the Genius Act was passed. That was a big regulatory milestone. What has been the impact? Because in your earlier reports, you said regulation is really a key enabler of digital money. Is the US on the way to becoming the crypto capital of the world, or are others fighting back? Just this morning, I saw an announcement that the UK's Financial Conduct Authority has just published proposals to regulate many areas of the crypto market. So are others also getting in on the act?
Yeah, look, this is definitely a competitive landscape, right? President Trump has said he wants to make US crypto capital of the world. I have to say, credit where credit is due. The US has made a lot of progress. The SEC and CFTC has made a lot of progress in a way reorienting the whole conversation around how digital assets should be regulated. There has been a personality shift and a personnel shift amongst regulators in the US, backed up by that legislation, the Genius Act. Now, the Genius Act only applies to stablecoins, which, as we've just discussed, is a relatively narrow element of the whole ecosystem. It's the very fashionable one in 2025. I think the key for 2026 for the US to maintain that momentum is they have to get, you've heard presumably of the Clarity Act, which is a market structure bill around digital assets to decide basically who's the regulator for a given token. That's been passed by the House, but there's various versions now in the Senate being debated. Get that over the line before the US midterm elections next year. I think that reignites the momentum the US has to lay claim to that crypto capital. But everyone else wants a piece of that pie. And the UK has been criticised for being a little bit slow, but I think it's also being careful. It has a lot of consultation papers out. You've just mentioned the most recent to arrive. And I think within that, the UK regulator and the Bank of England, FCA, have shown flexibility in terms of, I think, some of the more draconian ideas they had in mind. They've watered down in a positive sense recently. So again, reflecting the competitive nature that the regulatory setup will have in deciding who has a place in this market.
I guess from a regulatory perspective, it's a balance between preserving trust and security, but at the same time encouraging the development.
Yeah, look, you can provide maximum investor protection if you just don't allow anyone to do anything, right? Then you're like, fine, you can't lose a penny. I think what regulators want to do is not pretend that there's no risk involved in these assets, and just, I think, be transparent about what those risks are, and therefore afford investors all the protections that come. You know your risk, you know your potential return in your head, make your choice, right? So I think that's it, and also to ensure things like market integrity and you're not being front run, and you've got all the normal caveats of protection. I think to a large extent there is overlap in the approach that regulators have. It's then when you get down to the nitty gritty of where is that line of trade-off between innovation and protection? Where does that lie? And I think different regulators have different perspectives on where that line should be drawn.
Apart from the regulatory context, in our previous conversations, the Macro Brief, about digital assets, we've talked about regional differences. In particular, the US is all out on stablecoins, but in China, they don't seem to like that concept. Will everything eventually converge?
Hope so. I mean, I think in a way, it kind of has to, because this is going to be a global monetary system, right? If you think that's ultimately where we end up, is a world of tokenized money, your main moving parts will be tokenized deposits, central bank digital currencies, and private crypto money, including stablecoins. And I think they each have a role to play. We can debate what those relative shares might end up being. China, obviously, not still a fan of stablecoins or crypto, right? Fine.
Why is that, by the way?
Well, partly it comes down to they don't like the speculative element of the cryptocurrencies, so the bitcoins of this world. And on the stablecoins, they're nervous that it could undermine capital controls within China. So there is there's a policy perspective there. The US doesn't like central bank digital currencies because they think there's a privacy incursion issue, perhaps not such a worry in China. So there's different political and policy considerations. But it's interesting to see there was a little bit of news earlier in the year, and you got a sense that China might be warming to the idea of a renminbi stablecoin, and there's kind of a few headlines came out in Reuters and others. And then that got knocked on the head pretty quickly. It was like, no, ain't happening. But in parallel, you had Hong Kong, of course, have its stablecoin regulations passed and enacted and come into play. And you do sense that Hong Kong's the petri dish, right? Can they navigate stablecoins without it being destabilizing, where they can control the capital flows and understand it? So that, I think, becomes the path to some change in China. I don't know when, but I think that's the path. In America, a question I have, and I don't have the answer to, so you'll have to come back next year, is can we have global money without a Fed digital dollar, right? Can stablecoins really completely fill the void of not having a central bank digital currency in the US? I have my doubts. I mean, there are other ways of navigating that. But, if HSBC wants to send money to Citi, it would help to have a digital dollar that wasn't necessarily a privately issued stablecoin.
Yes, in order to maintain the primacy of the dollar, I guess, it's potentially in their interest to have that.
Well, I mean, look, President Trump would argue that stablecoins can achieve that, right? They're 99% tied to the dollar. That's why let's push stablecoins. But I think the nervousness from a banking perspective would be, do we want to run the counterparty risk of, let's say, a Tether or a Circle? Maybe they will. But I think they'd much rather be facing a central bank when moving money from one bank to another bank. That's what they've been doing for years in fiat world.
We're going to come back to Tether in a minute. But
okay.
We talk a lot about the concept of tokenized money, but what about tokenized assets? Does one need the other? What are you seeing in terms of development of digital assets?
Well, look, you can have tokenized money without tokenized assets insofar as tokenized money would still have value as a means of payment and as a means of moving money, particularly cross-border. That's one of the big use cases, for example, for stablecoins. But ultimately, what the vision, I guess, is, can you imagine all of equities on the blockchain, all bonds on the blockchain, and then having this massive pile of tokenized money to buy and sell them with? You would operate on the blockchain, because you may have heard a phrase like on-ramps and off-ramps, which is moving from fiat to digital and back again. Well, you wouldn't need to, would you? You'd everything, the whole ecosystem would be there. And tokenized assets as it stand, they're tiny, right? They look at the whole market of assets, depending how you measure, it might be 250 trillion, blah, blah, blah.
Can I put you on the spot? Give me an example of an actual...
A tokenized asset?
Asset.
Well, look, HSBC has issued a couple of bonds on chain. So it's not that you've got a token that is mimicking what's happening in the real world. The asset, the bond itself, is on chain, okay? There are those other forms where you track another on real life asset, real world asset.
Like gold.
Gold,
yes.
like
yes.
the tokenized gold product. So they're the examples. But for example, you said, hey, give me an example of a tokenized equity. There'd be crickets in this room right now, right?
Yeah,
so
we're not there
many.
yet. But
there's not many.
But potentially coming.
Yeah, I think so. And, it's significant. You saw NASDAQ this year applying to the SEC to say, hey, we want permission to host tokenized equities.
Yeah.
Okay. Well, why? Well, because, if we don't, somebody else will,
yeah.
right? So
and
it is in the
presumably,
future.
once you get tokenized money, tokenized assets, say you have a kind of tokenized equity market, does that make it a lot more efficient and frictionless?
Well, that's the vision. So if you have tokenized money, you should be able to give me money immediately. I know you never will, but in theory,
I'm not going to.
I know, but in theory, that's how it would work. And as soon as the money is received, atomically, you would get the equity from me. So it would be T+0, if you like, atomic settlement. It reduces all that reconciliation risk. It takes out some of the counterparty risk. It's very elegant. We've just got some distance to travel to get there. But that's the future for sure.
Talking about now, you obviously have a lot of meetings with institutional clients, corporate clients. What's your assessment of the level of understanding regarding digital assets? And is there maybe a case for saying that in 2025, a lot of the attention in terms of technological developments was on AI, and that actually there are significant opportunities for the taking in digital assets?
I think it won't surprise you here, the level of expertise varies. I mean, honestly, and I'm not claiming I'm anywhere near the top of the curve, right? There are obviously people out there, I would say, who've been trading crypto, so the Bitcoins of this world and other tokens like that, obviously for a large number of years and are very sophisticated at it. I think where the learning curve is most evident, though, is around the world of tokenization and stablecoins and, institutional investors getting their arms around this technology, and corporates, corporate treasurers. We get plenty of questions. Can I move money using stablecoins? Should I take payments in crypto? These are the questions being posed. I would say we're still at the question phase. I mean, maybe that's because they expect us to have the answers, but I do think that's where people are at. It's like, what can this do? How can I deploy it? But I mean, look at the BlackRocks and Fidelities of the world. They set up money market funds this year, and the flows into them have been large. There's ETFs or ETPs, perhaps more accurately, around Bitcoin and others, extremely popular. So the institutional embracing of this ecosystem has got bigger and bigger and bigger, and I think corporates will follow along that route with corporate treasurers looking for more use cases going into 2026.
What about security and vulnerabilities? What are the risks that we should be aware of? You have written, for example, about Tether having its S&P rating downgraded. Why was that?
Well, this was the Tether in particular. The Tether downgrade was the S&P looks at reserves. If you're a stable coin, you hold reserves so that when people come back with their Tether, for example, and say, I want my dollar back, you've got a dollar to hand over. Being able to do that, of course, means you should be holding most of your assets in dollars and be able to get to them quickly. The S&P perspective on Tether was that they were holding a progressively larger portion in reserves that were not necessarily immediately liquid or low risk in nature. So, they point to a growth in their holdings of Bitcoin and in gold. But I mean, it's slightly tricky. I mean, not all of it, but part of it would have been a valuation thing. This was they held assets that actually went flying up in value, right? So there's a bigger portion.
Holding it in gold wasn't such a bad idea.
No, I mean, not bad investment, for a while. Not bad investment ideas. But the S&P perspective was, but you could have sold them when they rose above a threshold that Tether itself had said was prudential, when they moved beyond that. So that's all fair. But what I like about it is it shows that we have to think about the risks around these. What's my redemption risk? What's the run risk on this stablecoin? The risk, or what the depegging risk? Who's holding those reserves for Circle, for Tether? Are they good counterparties? So you do have to think that it's not like just holding a pound or holding a dollar. You are holding a promise that I'm going to give you that fiat currency back if ever you come to me, so that you can trade on the blockchain or move money on the blockchain. So there are different risks. They're not interchangeable with fiat legal tender. They are a claim, if you like, echoing legal tender.
And to your point, it's actually a good thing that somebody is looking at that, that there is a kind of framework that sort of says, no, we are paying attention to this, and that sort of increases the trust in the instrument. Ultimately.
Yeah, it does. And it also, I guess, okay, so the theory here would be, of course, what it should do is all money would therefore gravitate towards whichever coins have the best reserves.
Yeah.
But no. It's not been too simple. What we actually see is, for example, Tether, that has the lower rating, in fact, the lowest rating of S&P in terms of measuring its reserves, the biggest market cap of any stablecoin, right? So, why is that? Now, it could be simply that it's got the brand, or it could be that people who use Tether operate outside of exchanges that the US has oversight on, right? And therefore, there is value for some to have privacy. Now, we can question why you want that privacy. It's not always for nefarious reasons, but you might just view, I want to move money peer-to-peer, and I don't need a US regulator on my shoulder or EU regulator on my shoulder, so I'm going to execute through Tether. And so the market cap of Tether remains really big. And remember, we said the market cap of a stablecoin just reflects the demand for that stablecoin.
Yeah.
So yeah, it's interesting. It's not. I think there will be different coins for different use cases. It's why Tether's launched a coin that will be US compliant, because it will have an audience, and then the non-US compliant coin will have its audience.
Yeah.
I'll leave it to you to decide who will be using which.
And the Chicago Mercantile Exchange had a cooling problem in one of its data centers, which caused quite a lot of disruption. For me, I was sort of, as I was preparing, I thought, is the irony that becoming ever more digitally reliant makes us all the more vulnerable to something that physical going wrong?
There is that vulnerability. You could make the case around, so for example, Bitcoin. You could make the case that it is a completely decentralized form of money. So your single point of failure risk is actually rather small with these cryptocurrencies, because you have multiple ledgers and they all hold the same information. You lose one, who cares? We got like 23,900, So from that perspective, less vulnerable. But look, we also have to acknowledge that even in this quote unquote decentralized world, a lot of the money goes through centralized exchanges. A lot of the mining is done by a small number of, there is still a degree of centralization and vulnerability. And of course, you do have, everybody needs the internet, everybody needs power to run these things. So you still have those vulnerabilities. But I'm not sure that it's peculiar to digital assets, as you just described. The breakdown you had there was unrelated. In the fiat world, we don't walk around with big wads of cash, not unless we're doing something nefarious. And so there, too, you're relying on technology to work and all of the above. So I don't think it particularly shifts the needle on those risks.
It's in the nature of new technologies that some developments get overhyped, whereas others get overlooked. So for 2025, was that the case? And how does that inform your predictions for 2026? Will that be the year when we resort to digital Christmas trees?
I think things landed pretty much as suggested for the most part. And I know it's a bit of a dull answer to the question. But, 2025, I think, was laid out as a year where institutional adoption would build. And I think that's proven to be true. I think where things might have been overhyped was for those who suggested that the immediacy of tokenization would knock banks, etc., to the side, right? Instead, what we've seen is banks looking at this and saying, what do we need to do here? How do we embrace it? How do we compete with it? Is this an opportunity? Is this a threat? Is this both? So it wasn't kind of the massive disruptor in the sense that tokenized money replaced TradFi. I think what happened was TradFi looked at tokenized and said, okay, interesting. So maybe that was a bit overstated. The idea that this was just like bank's Kodak moment. It just, we haven't heard the shutter. I suspect the thing that was perhaps underplayed was how popular mainstream financial products were that embraced digital assets. From a regulator's perspective, you rewind the clock 2 years, these were sketchy stuff. It's like you did not want to go near them. And even banks were told, don't go people who, whereas now, as mentioned, you've tokenized money market funds. You've got exchange traded products that give you exposure to Bitcoin. You have something we haven't talked about, digital asset treasuries. So the likes of Strategy buying Bitcoin and putting them into an equity envelope so that equity investors could get direct exposure to crypto. It was the idea, I think, that this as an asset class and as a technology moved into the mainstream of investors and retail through to institutional. I think that was underplayed at the start of the year. So maybe they were the two underplayed and overhyped.
So Nicholas Negroponte's prediction of being digital continues apace.
Well, I'm still looking at a very physical you. You're looking back at a very physical me. So I know there is an AI actress out there. I've forgotten her name. But for now at least, we've not been digitized.
Yeah. Our time may come. But on that note, thank you very much for joining us for
Cheers,
the last podcast of this year. I do wish you a very good festive break, digital or otherwise. And I look forward to carrying on the conversation in 2026.
Thanks, Piers. Lovely to chat.
So that's it from us this week, and indeed this year. Don't forget that if you're an HSBC client, you can keep up to date on our latest research by downloading our mobile app. And if you're looking for a new podcast to listen to over the holiday season, then check out our sister podcast, Under the Banyan Tree, where hosts Fred Newman and Harold van der Linde put Asia's markets and economics into context. Finally, if you've got any questions or comments, you can get in touch with us at askresearch@hsbc.com. Today's podcast was hosted by me, Piers Butler, and produced by Tom Barton. From all the team here at Global Investment Research, thanks for listening to us this year. We'll be back in 2026.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.